We're going to give you the 5 reasons. Well, there's probably a lot more than 5, but we've limited it to 5 because it's only an hour program. Why tax planning should be an integral part of your overall financial planning, regardless of whether it's tax season or not. Plus, we will recap sort of the tax season trends that we saw during the course of this past tax season. Hard to believe. Here it is, April the 9th, and that means that there's 9 days, not 6, until your tax filing deadline. Tax filing deadline this year falls on April 18 because the 15th is Saturday, and then there's a holiday in Washington, D.C. or somewhere. I think it might be Patriots Day in Massachusetts as well. Running of the Boston Marathon, all that good stuff. Anyway, that means that the deadline has got to fall on a business day. That's why this year it's technically April the 18th. Also, of course, today, Sunday, it is Easter. So we wish everyone a happy Easter, along with the fact that it is Passover as well. So we wish folks a happy Easter, happy Passover. And of course, we welcome you all into the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, I'm Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of which happen to be also certified financial fiduciaries, but they may be certified financial planners, they may be CPAs, they may be IRS enrolled agents, they may be National Social Security advisors. Whatever the case may be, we've got you covered with the team of great folks at Nelson Financial Planning. So feel free to reach out to them this week to see how we might be able to help you improve your life with a successful and cost-effective financial plan. So here we are, already 1 week into the second quarter of the year 2023. For those of you who get your statements the old-fashioned way, which would be through the mail, then you should be getting your statements for the first quarter of the year. If you get them electronically, chances are you got them last week. Remember that conversation from last week's show, right? One of those things that those statements shows beyond how your investments are doing is that they'll typically give you a great opportunity to review how much it is that you're actually paying. And remember the little math exercise we did last week. You take that total expense, that total cost, if you will, multiply it by 4, because, again, that expense, that investment expense that you're incurring over the course of a 3-month period, to find out what that is annually, you would multiply it by 4. And what we're talking about here is like the management fee, doesn't include sort of the underlying investment expenses. Those are always there. But the management fee or the advisor fee or the financial fee, if you will, is something that you can most certainly control. For the most part, you can't really control the underlying expenses of the investments. I mean, there is some wiggle room to do that, but not to the same extent as you're looking at the compensation you're paying for whatever it is that are the services that you are receiving. So take that number of the management fee or the advisor fee or the investment expenses, multiply it by 4, and then divide by the total value of your account. Now, here's the piece that you might miss. You got to multiply that number by 100, okay? And then if that number is above 1, meaning that you're paying more than 1% on the advisory side of whatever it is that you are doing, well, in our view, you might be paying a little bit too much. Not uncommon to see those numbers at around 1.25, 1.5, sometimes even as much as 1.75. So make sure you're checking that out and doing that math, using those quarterly statements as a good opportunity to not just review how your investments are doing, but what the underlying cost is that you are paying. Now, what you should also notice, of course, assuming a diversified portfolio, You have 75% on the stock side, 25% on the bond side. Lo and behold, despite all of the different headlines that are out there, certainly been a slew of headlines so far this year in the year 2023, ranging from bank failures to more rate hikes, still consistent or persistent high inflation. Against that backdrop, you might be somewhat surprised to see that, hey, wait a minute, these first quarter results are actually positive, actually, improved on where I started the year out at. And certainly when you look at the overall markets as a whole, now the Dow, which is sort of just 30 companies, was basically flat for that first quarter, but S&P 500, a little bit more broader, wound up being up 7% for the quarter. Interestingly, the NASDAQ, which was the index that went down almost 33% in the year 2022, had a pretty good recovery in the first quarter, up about 17%, the largest relative outperformance to the Dow since the year 2001, so almost 20 years in terms of that relative outperformance. And I guess that sort of highlights, right, another reason why if you throw out of your portfolio the thing that happened to do the worst, and you do that without sort of any perspective, well, then oftentimes what happens is you miss the recovery that then follows. And that's kind of a classic example, right? So at the end of the year, you look at your statement saying, man, all of my really heavy tech stuff, all that went down so much, I'm done, I'm out. And then poof, within 3 months, that same NASDAQ index goes up 17%. So pretty interesting kind of turn of events. Certainly one of the reasons why, while you certainly want to rebalance and make sure you are diversified, very difficult to just willy-nilly throw out a certain portion of the portfolio just because you no longer sort of like it. The reality is that as we see, whether it's stocks, bonds, whatever the case may be, after periods of difficulty, those periods followed by periods of improvement. And so that was certainly the case, particularly if you look specifically more at those large tech companies. So despite the headlines, you may very well be surprised as you look at your statements. One word of warning, though, on certainly a trend that really developed here in the first quarter. Investors added a net of $336 billion to money market funds. In March alone, it was $283 billion. So March really clearly investors were spurred to sort of action as a result of sort of the banking headlines that happened. But I think also investors got a little tired of not seeing any change in their savings rates, particularly at large banking institutions, so those traditional banks. So you saw a tremendous amount of money flow over to money markets within that period of time. And that's great because actually, within a money market account, you're probably finding something north of 4%, which is certainly a lot better than anything that you've seen for probably 15 years. But before you fall in love with it, consider that inflation still is at 6%, right? So yes, making 4 is good, but inflation's at 6. By the way, that's why the interest is at 4. So don't start to view that as a solution to your portfolio. It should be a part of anybody's investment allocation, but don't view it as this grand solution, because if inflation's running at 6, 4 sounds good, but it ain't good enough. With that, we'll take a break and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So why is tax planning so crucially important to financial planning, and not just at tax time, but throughout the year? Well, we're going to give you 5 specific reasons for you to be thinking about the role of tax planning in your overall financial plan and why it is so important. So welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out there. If you miss any part of the show, maybe you are on your way to Easter and you caught part of the show, but you're interested in hearing the rest of the show. Well, that's easy. Go to our website, nelsonfinancialplanning.com, and then you'll see a bunch of icons. Click on the one that looks most familiar to you, and whether it's Spotify or iTunes or Amazon Music, whatever the case may be, we've got a channel on all of those platforms so that you can listen to our program at your leisure. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of certified financial fiduciaries that stands ready this week to help you change your life with a successful and cost-effective financial plan. So one of the things of tax planning as it relates to overall financial planning is the crucial interrelationship between the two. And at Nelson Financial Planning, we view it as just so crucial that I think it was 20 years, maybe over 20 years ago, we actually started to do tax returns, actually prepare tax returns as a service for our clients, because it struck us that you can certainly do an approximation or an estimate of your taxes, but at the end of the day, it's kind of convoluted. I mean, most of the time you really kind of need software to kind of run exactly what the numbers might be. So yeah, you can probably get a rough approximation, but if you want to really get a finely tuned analysis, then you sort of have to actually do the real tax preparation, actually put it into a Form 1040 and, kind of see what spits out. So over 20 years ago, we would be coming up on 25, we actually started to do tax returns for our clients here at the office at Nelson Financial Planning. Today we do, I think, over 600. So we certainly see our share of all kinds of tax issues that can crop up, predominantly for folks that are approaching retirement or folks that are in retirement. It certainly pays to have on the team a full-time CPA and a full-time IRS enrolled agent make up sort of the backbone of our tax expertise. And certainly, if you're a regular listener to the program, you've certainly over the years heard Kristen Cayley and Christina Lamb kind of speak to their expertise and join us for a segment on the program. Of course, these days they are kind of busy, so we'll probably have them on in a month or so once they've kind of cleared the season. Anyway, so what are some of the areas where that tax planning and the relationship to financial planning becomes so crucial? And I guess the first area is understanding the difference between gross versus net, right? People talk about their income. They usually kind of talk about the gross number. Oh, I make 100,000, or oh, I make 75,000. That's the gross number, right? That's not actually how much they get deposited into their bank account. That is the net number. Now, when you're working, there's no way to sort of override that, right? Because if your W-2 is your W-2, then you're going to have your employer running the calculation in terms of tax withholding and in terms of FICA tax and things like that. And then voila, you get deposited into your checking account the net amount. And of course, the net amount is what we all live on. Well, that's particularly important to understand that distinction, because when you become retired, you're going to be generating out income. Well, you still need to think of that income that you're generating as gross income, not net. And the responsibility then to account for the difference, to account for Uncle Sam's cut, if you will, now rests on you. So oftentimes what people forget is they say, well, my net income is $6,000, so all I really need is $6,000, and I'm going to be fine, and I'm going to be able to replace all of my income and be perfectly happy in retirement. Except for the fact that now the burden of that gross versus net conversation has shifted to you. So that means that you've got to understand how much those numbers need to be grossed up. You have to plan for the tax man in retirement. He's got to be one of your budget items. And oftentimes we see people sort of forget that gross versus net, and how do you account for it in retirement. And so when that happens, you want to make sure that you are not sending more money in than you really need to, right? Because otherwise you're getting less money, or you're taking more out of your accounts than you really need to in order to satisfy that tax liability. So remember, you spend the net, not the gross, but in retirement, you got to account for the gross. And that's why certainly planning those taxes becomes a very crucial part, particularly when we're thinking about the retirement income planning portion of financial planning. Next up, in terms of why it's important to sort of integrate tax planning into financial planning, is Social Security. And this is one that there's probably not a day that doesn't go by where somebody says to me, Social Security, why is that taxed? Or that never should have been taxed, or that wasn't supposed to be taxed, or is that taxed? Really? Well, the answer is yes. Now, there's some thresholds that make it sort of depending upon other income that ultimately determines its full tax liability. So lower income, less taxable, and ultimately there's an opportunity to sort of take advantage of it. Now, here's the kicker, and we've said this before on the program. Those thresholds that trigger taxation of your Social Security have not changed in 40 years. They were never inflation adjusted, so they still remain for a single person at $25,000, married couple at $32,000. Here's the other kicker or secret part of it. What counts towards that threshold is not just income, but also half of your Social Security comes back into that calculation. So you can see where very quickly you wind up having to pay tax on your Social Security. But if you find yourself in that range where Social Security might not be taxable, or maybe only 50% of my Social Security is taxable on up to that maximum of 85, then there can be some opportunity to take advantage of that provision, especially if you think about it again in terms of where your retirement income is coming from. Maybe your retirement income might want to come a little bit more heavily from your Roth account, or maybe your retirement income might want to come more heavily from some of those after-tax investments that you have in order to bring those numbers down and maybe avoid some of the tax on Social Security. Again, you spend the net, not the gross. So if you can reduce that as much as possible, then you wind up with more money to spend. Number 3, and this one is one that I think more and more people are dealing with. It's still a surprise when it happens because it can be pretty dramatic, and that is IRMAA. And what IRMAA is basically a means testing based upon your income of how much you're going to pay for your Medicare premium. Now, the issue here that you need to be aware of is those one-time transactions where you could wind up paying double or triple the usual amount that you would pay for your Medicare for an entire year. So here's how it works. Medicare, again, means tested every single year. So every single year, let's say January of 2023, they looked at your most recently filed return, which would be 2021. So that's the 2-year gap that they're looking back on, and looking at that income and determining where you are in terms of those income thresholds. What they do next is then determine what your Medicare premium is going to be for that coming calendar year. And we'll get into the thresholds of all of that when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're talking about the 5 reasons why tax planning is so important as part of your overall financial planning, regardless of whether it's tax season or not. In the last segment, we talked about 2 of those reasons and got started on a third. If you missed it, one of the reasons why tax planning is so important to financial planning is that you have to understand the difference between gross versus net. The reality is you spend the net in retirement, though, you're still responsible for the grossing up of that number to pay Uncle Sam. Number two, Social Security. At different levels, it's taxed differently. Where are those levels and what makes it less taxable or more taxable? Number three that we were kind of working through is this notion of IRMAA, the income adjustment amount that applies for Medicare. That a lot of people comes as a surprise because you can have a single transaction that easily triggers it right out of the blue. So think about a property that you're going to sell, or maybe something that you've inherited and that winds up hitting the return all at one time. Well, if that jumps those numbers up in terms of your total income, then you can see your Medicare go up 2 times, 3 times what it previously was. Now, the good news, to the extent that there is that only lasts for that particular year. But at the end of the day, it can still come as a tremendous surprise, because what happens when they charge you more for that Medicare is that they reduce your Social Security accordingly. So those thresholds that trigger it are relatively low. As a single person, it's $97,000. As a married couple, it's $194,000. So it doesn't take much of a sort of a transaction or income, for that matter, but certainly on a particular isolated transaction like the sale of a property or an inheritance or something like that, you could very easily get in front of those limits, thereby paying much more for your Medicare than you ever realize. So in that particular case, it's important to sort of be thinking about creating a strategy where maybe you look to take money out over time rather than all at one shot. So maybe you think about doing an installment sale on the sale of that property, or on an inherited IRA, you don't just take all the money at one shot. You spread it out over that 10-year period that allows you to more properly manage the impact that could have on your Medicare. And so it's so important to kind of start planning that one now. We actually saw a very specific situation just this past week in the office talking about all of this, and it involved an individual who was renting. They were retired and they were renting, but they said, well, I kind of want to buy a house. The whole story of, they got divorced and lost the house, and so renting. And so they're like, I want to kind of get back into owning a home. So I'm thinking about using my retirement account, to take out a big chunk, and then that becomes a down payment. And that would have just immediately triggered a much higher amount on their Medicare premium. So our suggestion was, well, if you think buying that house is 2 or 3 years out, well, then let's sort of plan on building up your savings account along the way. And we'll, sort of send a little bit extra. You take a little bit extra income each and every month, maybe more than what you need. But at the same point in time, you're taking that extra and you're banking it into a savings account. And then that way, you're not blowing up your Medicare down the road in terms of that premium. So that's one of the ways in which sort of that overall tax planning and financial planning is so important, to integrate those two, particularly when it comes to Medicare and the means testing that happens on that. We've got a couple more as well for you to be thinking about. Welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast platform, or even on our YouTube channel as well. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you improve your life with a successful and cost-effective financial plan. So the next category that we wanted to talk about, why it's so important to integrate tax planning with financial planning throughout the course of the year, is dividends and long-term capital gains can be free. Dividends, capital gains, that's right. You can get a dividend or you can get a capital gain, and it comes to you as free. No taxes, 0% rate. Isn't that amazing? The reality, of course, is that even at higher income levels, dividends and long-term capital gains have lower rates than ordinary income. Different tax rates exist for those types of categories of income versus, say, pension income or IRA income or even Social Security income. So if your total gross income is roughly around $100,000 as a married couple, then any dividends or capital gains that are in that are going to be taxed at 0%. Well, that's pretty good. That means you get to keep all of the dividend for yourself. And this is a preference that's been in the tax code now for probably 15, 20 years. Regardless, if your income is higher, you still wind up paying a much lower rate on those 15% versus, say, 22, 24, or even higher in terms of income tax rates. So that's one of the things that you certainly want to make sure that you're taking full advantage of, because those rates certainly do allow you to have a 0% rate, tax-free, if you will, on your dividends. Got to be qualified dividends, and capital gains got to be long-term capital gains, can't be short-term, long-term. Got to have held it for more than a year. So there's a couple of little fine prints on that, but with dividends, capital gains, great opportunity to not pay any taxes at all on that income. So certainly some powerful stuff there, and certainly something that you want to make as part of your overall financial plan. Because at the end of the day, and the last reason, when you retire, it's all about maximizing out your retirement, right? Remember, you spend the net, not the gross. That's why it's so important to make sure that, as we said earlier in the program, why it's so important to understand and know what your investment management expenses are, what your advisor fees are, what all of those expenses are, because those wind up subtracting away from your gross amount or gross amount of money that you earn. And at the end of the day, you want to obviously minimize that as much as possible. Remember, of course, the more that you keep of your money, the more you have to spend. If you're minimizing your taxes, and on the program, we've talked just kind of about some of the quick and dirty highlights, but there's a ton more ways to do it, whether you're using qualified charitable distributions as part of your required minimum distribution on your IRA, whether you're bundling deductions, maybe putting a bunch of those charitable contributions together, or maybe paying a couple of years of your real estate taxes all in one year. There's a lot of different strategies that you can use to help minimize your taxes. And when you're minimizing your taxes, that means that you are maximizing out your retirement. So those are just some of the ways in which that tax planning is so crucial to have during the course of any year, particularly when it relates to financial planning. So, number one, beware of the difference between gross versus net. Number two, know that Social Security is taxed at different levels depending upon how much other income you have. Number three, beware of IRMAA, beware of the means testing that comes with your Medicare premiums. The more money you make, particularly if it's a year where you had a transaction that sort of caused your income to spike, well, then you're going to pay as much as 2-3 times the amount of what you would traditionally pay for your Medicare premium. And then remember, dividends, capital gains, they are a freebie if you're in that 12% income tax bracket or lower. So typically for a married couple, $100,000 or less, then that gives you a 0% tax rate on those qualified dividends and long-term capital gains. And then lastly, it's all about maximizing retirement, right? The more you keep, the more you have to spend. Make sure you're maximizing it out by making tax planning a significant part of your overall financial planning, not just at tax season, but throughout the year. With that, we'll take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Speaking of taxes, right? 9 days left. Hopefully you're able to celebrate Easter and Passover without the dark cloud of preparing a tax return still looming over your head. But I know that many still have to do their taxes. You got 9 days left from today, April the 9th. The reality is the tax filing deadline, as we mentioned earlier in the program, April 18th this year. Why? Because 15th fell on a Saturday, and then the Monday was a holiday, and so voila, the next business day after April 15th is April 18th. So that's the deadline to make sure that you've got your taxes on in. On our website, as we do every month, we do a blog post. And so this month's blog post features some of the trends that we've seen sort of developing over the course of this particular tax season. And so this particular tax season had a tremendous amount of changes, maybe not that were actively done, but rather a bunch of stuff that sort of happened in that a lot of the COVID rules or stimulus checks or child care credits, things like that, sort of disappeared for tax season that was for calendar year 2022. Similarly, you had some rough headlines during the course of the year 2022 that made for not as good a market performance as what you would typically like. So that led directly to some of these trends that we're talking about and we wanted to share with you here in the program, and also put in much greater detail on our blog post. So if you're curious for more details on the topics that we're going to talk about in this segment of the program, go to our website, Nelson Financial Planning. You'll see a little thing that says from the desk of Joel Garris. That's kind of the blog post area. And so the topic for this month, obviously very timely, some trends in the current tax season. So first trend is really more of a trend that we see applying to folks that are retired or folks that have investment income or portfolios. And I guess in a way, this is sort of the only silver lining that comes from the markets in 2022, because if you remember 2022 wasn't really a particularly great year for the overall stock market, the overall bond market. All of those markets had negative performance for the calendar year. Well, when the market performs badly like that, as you might well expect, things like dividends go down, things like capital gains go down, all of those things reduce down. So if those are reduced down, then at the end of the day, then you've got less of an amount owed or less of a tax liability as a result of that. So that's kind of one trend that we saw really playing out among folks that are close to retirement, retired, that have investment portfolios. So that was sort of that piece of the trend. The flip side, if you will, which was sort of a trend that went the other way, is that generally we saw that families, young families, had lower refunds. And so that was directly as a result of a lot of the changes that happened, or should I say the expiration of a lot of the COVID-related types of tax changes that were added during the course of 2020, 2021, things like the enhanced child tax credit, things like the dependent care tax credit, all of those COVID-era types of tax credits all sort of disappeared. And that meant then that if you have a lot less credits, then your refunds are going to be smaller. So that was sort of directly the opposite. Like with retirees and things like that, we saw sort of lower tax bills. With families, folks with young kids, things like that, you saw higher tax bills. So two totally different trends depending upon sort of which age category, if you will, you found yourself in. The other trend that we saw, which I think this trend is certainly going to continue, and that is just the sheer proliferation of tax forms. It seems like every transaction that you do in society as a whole, there's a tax form now that accompanies that. So whether you sell a piece of property, then you're going to get a 1099. Whether you've got a legal settlement, then you're going to get a 1099 for that. And beyond the 1099s that are generated out from a place like Ticketmaster or Etsy or those kinds of things. It is these normal transactions that now create 1099 requirements. And what happens when you get any kind of those tax documents, what you have to understand is that somebody else also got a copy of that tax document. It's called the IRS. And so they're using that information to match that up on your tax return. So what that means is that when you get a 1099, you just can't ignore it. You've got to actually look at it. You've got to deal with it, and you've got to figure out the right way to get it on your tax return. Now, here's the kicker. You've really got to make sure that you are on top of these tax documents before they get issued. We saw a couple of cases just this past tax season that really created a lot of heartburn for the taxpayer and ultimately had to look at creating solutions in these two cases. One of the cases, and we talk about this in much greater detail on our blog post on our website at Nelson Financial Planning, but one of the cases involved the sale of a property that was held by a trust. And in this particular case, the closing agent, the law firm, just generated a 1099 out to just the sole trustee of the trust. The problem is that the trustee is the trustee. They weren't any of the four people who actually got the money. So that transaction or that 1099, which showed up in the trustee's social security number, created a huge tax liability for the trustee about a transaction and about money that they never got. So it's important to stay on top of when those things get issued to make sure that you know, hey, wait a minute, this doesn't look right. You've got to reissue this. In this case, the entity that issued the 1099 didn't really want to change it. So what we needed to do is to work with the individual to basically go through and reissue out from them personally separate 1099s to the four beneficiaries who actually got the money on the real estate transaction. So just a terrible situation. Ultimately, there was a solution, but it could have been easily fixed by making sure that the folks at the front end issued out the 1099 in the proper way to the proper people. It's also important in the second case study that we mentioned on our blog post to make sure that the actual 1099 that gets issued out, because there's like 20 different variations of a 1099 that you can get, probably more than that actually on thought. And in this particular case, this involved a legal settlement, and the legal settlement was issued out on a 1099 NEC form. And what that then was triggering was not just that they had to pay taxes on it, but they also were going to have to pay Social Security wages on it. So it was basically like got taxed out or treated out as wage income when most clearly it was not. In this case, fortunately, the individual was able to get the issuing entity to change the actual tax form. That's rare, but that was successful and certainly allowed that person to be able to avoid some of the big tax implications on it. So bottom line, make sure you pay attention to those tax forms that are getting issued out, because there's a lot of them that are getting issued out these days. Well, that's about all for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more, feel free to reach out to one of our certified financial fiduciaries at Nelson Financial Planning. Visit our website, nelsonfinancialplanning.com, or call us at the office this week, 407-629-6477. Thanks for listening.